Welcome to the Torch Academy. In this episode, we're covering the direct market data method, the #1 valuation approach for businesses under $1 million. This is the most straightforward valuation method. Instead of building a complex model, you simply look at what similar businesses actually sold for recently. A dental practice in your town sold last year for a certain price. 3 similar bookkeeping firms sold in the past 2 years at certain prices. That data is gold because it tells you what the market is actually paying right now. It is not theoretical, it is real. BizComps and DealStats are the primary databases that collect small business sales data and make it searchable. You can filter by industry, revenue size, location, and find comps. The data comes from small business appraisers, online databases, and deals that are publicly recorded. The process is simple. Step 1. Search the databases for comps. You want recent sales, ideally last 12 to 24 months. 3 to 5 comps is ideal. Too few and you get outliers. Too many and you lose specificity. Step 2. Extract the data from each comp. What was the revenue? What were the earnings? What was the selling price? What multiple does that represent? Were there any special factors? Step 3. Adjust. If one comp sold to a strategic buyer, adjust down. If another had unusually low growth, account for that. If yours is larger or in a better market, adjust accordingly. Step 4. Apply. Take your adjusted multiple and apply it to your business. If adjusted comps suggest a 2.8x revenue multiple and you do $600,000 in revenue, your value is $1,680,000. Let me walk you through a real comp adjustment. You are valuing a bookkeeping firm. You find 3 recent sales. The first was $380,000 in revenue, sold for $950,000, which is a 2.5 times multiple. The second was $420,000 revenue, sold for $1.12 million, that is 2.67 times. The third was a larger firm at $650,000 revenue, sold for $2.1 million, that is 3.23 times. Your firm does $480,000 in revenue. You are closer in size to comps 1 and 2. They got multiples of 2.5 and 2.67. Your firm is slightly bigger and similar in profile, so you might add a small premium, say 0.1x. Your adjusted multiple is 2.6 times. Applied to your $480,000 revenue, your value is $1,248,000. That is grounded in actual market data. Every comparable sale is different, so you adjust. Size. A business your size should get a similar multiple to same-sized comps. If you are comparing to a much larger business, adjust down slightly. Growth. If a comp had exceptional growth, it probably got a higher multiple. Account for that. Location. Market conditions differ. A business in a thriving market might have sold for more than one in a declining area. Owner dependency. Was the comp owner heavily involved, or was it a turnkey operation? Adjust accordingly. Strategic buyer. Sometimes a strategic buyer, a larger competitor buying for synergies, pays a premium. If your comp sold to a strategic buyer, you might adjust down since you are probably selling to a financial buyer. Recency. Sales from 6 months ago are more relevant than sales from 2 years ago. Adjust for that. Customer quality. Recurring revenue commands a premium over transactional. Each adjustment typically changes the multiple by 0.1 to 0.3 times. Small, incremental changes. When you have 3 to 5 good comparable sales from the past 12 to 24 months and you adjust properly for differences, the direct market data method is remarkably accurate. Studies show accuracy within plus or minus 10 to 15%. That is good. It is grounded in actual market behavior. This is why professionals love it. It is data-driven and defensible. Direct market data is powerful, but it has limitations. If your industry has lots of sales data, it is great. But if there are only 3 sales nationally of businesses like yours in the past 2 years, you have got a problem. Comps might not exist or might be weak. If your business is highly specialized or unusual, finding good comparables is tough. And if you have implemented massive improvements, like reducing owner dependency or growing to 25% annually, comps might not reflect your current position. In those cases, you combine DMD with income approach or asset approach to triangulate. But when you have good comps, DMD is the most reliable and transparent method. Think of DMD and income approach as complementary. DMD answers, what did the market pay for similar businesses? Income approach answers, what should a buyer pay for this earning power? Both are valid. They sometimes give different answers. If DMD says 1.2 million and income approach says 1.4 million, investigate why. Maybe your earnings are better than comparable businesses. Maybe your business has characteristics comps did not have. Smart appraisers use both and weight them based on data quality. If you have great comps, weight DMD heavily. If earnings are solid and comps are weak, weight income approach heavily. You can access this data yourself. BizComps and DealStats charge per search, but it is relatively inexpensive, $250 to $500. You search by industry, location, and revenue range, and you get a list of recent sales with details. The SBA also publishes loan data that is free and searchable, though it is less polished. Or you can hire a business advisor to search comparables for you. Many professionals will do a preliminary comp search for free as part of evaluating your business for sale. If you are not sure how to interpret the data, that is worth paying for. An online platform can search comps, adjust them, and give you a preliminary value opinion for $500 to $1,000. That is a worthwhile investment. Here is a critical point. The quality of your comps determines the quality of your valuation. If you grab random old sales data or comps that are not really similar to your business, you will get a valuation that does not mean anything. Use recent sales, ideally from the past 12 months. If you cannot find sales that recent, 18 months is acceptable, but older than that gets less reliable as market conditions change. Use comps that are similar in size and business model. A comparable business should be close to you in revenue, profitability, and profile, and verify the source. Professional databases and verified transaction records are more reliable than hearsay. 3 to 5 good comps beat 10 weak ones every time. The takeaway: if your business earns under $1 million, the direct market data method is probably the most relevant way to estimate your value. It's based on real transactions in your industry, not theoretical models. Search for comparable sales data in your sector and use it to set realistic expectations before going to market. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.